you a very good occasion to look at slightly longer term views. And what's surprising me is that if Harsha says he is positive on auto, cement, retail banks, I spoke with Naren, the Chief Investment Officer of ICICI Prudential, and he said actually the exact opposite. He's very positive that there is an economic upturn coming, and therefore corporate-facing banks are the place where you must place your bets. Not only are they available cheap, they are the story of tomorrow. They have not been the story of the last 5 years. Let's listen in to our Samvat 2073 market master, Naren.
I don't think the earnings turning quarter can be this particular quarter. I think clearly if you look at the quality of earnings, it'll improve in metals and many of the other areas, but there are industry-related earnings in banking and capital goods which all have to improve over the next few quarters. And without that happening, I wouldn't call it a turning quarter. Having said that, we are a believer that earnings will pick up gradually over the next 2 years. The economy will pick up continuously over the next 2 years. And earnings will accelerate once we have a private capex cycle, which we expect now only in 2018. So, which is why we believe that the outlook for the next 2 years is pretty positive.
Okay. But if capex is not turning, what will you rely on as the leaders of, say, the next 12 months? Will it be consumption?
See, clearly it has to be, over a period of time, it has to be cyclical sectors. Today, it can't be the consumer sectors or the very defensive sectors like IT. It doesn't look like IT is turning around immediately. So I think clearly it has to be financials over the next few years. It has to be capital goods over the next few years. It has to be areas like utilities and maybe sectors connected to the economy like construction, which all have to improve over the next 2 years. Okay. I think that's where the battle is. When we look at valuations, we can clearly see that the market is not cheap. Although we think that the underlying economic cycle is improving, we don't think the market is cheap, and that is clearly a bottleneck in expecting big returns.
Okay. Okay, let's start with financials then. What in financials? For the longest time, we have heard this private sector being better than public sector, but would you say the tide is turning? And likewise, would you say the NBFC sector is still worth buying?
So actually, I think if you look at the NBFC sector, while it is not part of the large cap indices, any sector where you have so many new entrants coming and so much of money being raised is normally a sector which is in a boom. So I would say that NBFC sector is going through a boom. And I think over the next year or so, we will have to be cautious investing in equities of NBFC stocks, because they've all actually gone up substantially. On the other hand, banks, I think the NPL cycle will possibly peak out this year. And over the next 2 years, you're going to see an improvement in the NPL cycle. And that improvement in the NPL cycle is likely to result in earnings improvement, which I think will happen over the next few years rather than 1 or 2 quarters.
We have been, a function of global flows. Would you worry that there can be something like an apocalyptic situation, either because of European banks or the Fed's moves?
So I think if you're going to have an apocalyptic situation, you're not going to see any returns in equity markets. And what we do believe is that the global central banks have spent the last 5 years trying to prevent apocalyptic situation. Consequently, we do believe that when we look at the next few years, the optimism is based on local factors, and global factors we believe only can be marginally negative over the next few years, because none of the issues that are there in most of the world except US have got resolved. Growth doesn't seem to be coming back. And we are not able to see the problems that are getting solved in many of the countries. So I think clearly the global backdrop is nothing great. They've used the interest rate route significantly. And today, if post the US election, if the government in US decides to use the fiscal route to revival and you have a big move in yields, that would turn out to be negative for Indian equities. So I think clearly the biggest risk, as you correctly pointed out, is global. And we should not see a big spike in interest rates. Any big spike in interest rates can lead to Indian markets going down.
Okay. A favorite question these days is, how much are we dependent on the US elections? Will that be just a lot of drama and it will pass? Or should we be prepared for something nasty on November 9th?
You know, we are not able to guess Indian elections. And then do you think we have any capability to guess US elections? So what we do is we look at what is happening to the Mexican peso, and we are seeing what is happening to the betting markets and making a judgment. Clearly, if the US election result turns out to be someone who is interested in increasing interest rates significantly in US, that would have a massive negative impact, not just on Indian equities, but on global emerging market equities. Okay. We hope that any increase in interest rates in US is orderly, because a disorderly increase in interest rates would lead to Indian equity markets coming down. I would say, if I had to look at the risk to Indian equity markets, it doesn't come out of local reasons. It comes out of a big spike in interest rates in the Western world. I'm not a believer in it, but if it were to happen, it can cause a correction in the markets.
Crude, we've seen it go to 57. Should we worry that this may be the last of the year when we have this low crude advantage, and some of the current account, fiscal deficit and other advantages that have accrued to us may fray away in 2017?
See, clearly we are hoping that at $60 crude, shale comes back into production and acts as a cap on global crude production, global crude oil prices. Yeah. So if that were to happen, I think that would be bad if oil prices were to shoot up. I don't think it will be good for Indian economy. But one thing we should remember is that as oil crashed from $50, actually a lot of petro money invested in India went out. So if oil were to go up, I think there is a chance of petro money coming back to India. So I think the more immediate impact on Indian markets would be on fixed income and not equity. I think equity can benefit out of sovereign wealth flows if the oil prices go up.
Right. Well, through today and over the weekend, we will get you more views of S. Naren and what are the key stocks that he would bet on in the next 12 months. Not very positive in the near term, but quite clearly thinks that equities is a great 2 to 3 year bargain, and there is no other asset which is as good as equities at this point in time. Take a break on that note.